Markets made history this week as both stock market indices and Bitcoin made new all-time highs. So what's been driving this rally and where is it headed from here? Let's find out. We're going to show a compilation of the guests on my show who have correctly called this rally for both stocks and Bitcoin and show their outlook. But before we do that, comment down below on what you think is going to happen and what you're doing now. Are you selling into the rally and taking profits, buying more, or waiting on the sidelines for a dip? Let us know. And as always, if you're new here, subscribe and share the video. Don't forget to sign up for my new free newsletter for more market updates. Substack link in the description down below. Okay, starting with stocks, let's flip over to my screen and we'll take a look at the S&P 500. So the S&P benchmark has extended a remarkable recovery from April's near lows. It's been in bear market territory for quite some time, ever since the beginning of March to April. It tanked 18.9% from its February highs, all the way down to its April lows. Year to date, the S&P gained about 6%. Let's take a look now at some key events that drove price action throughout the year following Trump's January 20th inauguration. Markets initially rallied to record highs by February 19th. However, the Liberation Day event on April 2nd triggered a sharp 12% correction in the S&P 500, pushing the index into bear market territory. That's right here. The subsequent April 9th announcement of a 90-day tariff reprieve, which excluded China at the time, caused an immediate recovery, with the S&P surging 9.5%. Later, geopolitical tensions escalated in June, with Israel's Operation Rising Lion attack on Iran on the 13th causing oil prices to spike. Let's take a look now at oil. That's a spike now in oil, over 10%, and markets to retreat just modestly. The brief but intense Iran-U.S. military exchange from the 23rd to 24th caused another surge in oil, but the price came down right after a ceasefire was negotiated and announced. Markets have shown sensitivity to geopolitical risks like we've seen here. But more importantly, we've seen that geopolitical risk premiums don't typically last very long, as is evidenced by this drop in oil. Interestingly, Fed policies seem to have had little impact on markets throughout the year. The Fed has so far not changed their policy rate, as we know, all year long, and they've instead implemented a data-dependent strategy. They're going to wait and see. While headline CPI inflation has fallen to 2.4% from 3% at the start of 2025, the FOMC committee remains cautious about the tariff spillover effects on inflation, which they're concerned may be reflected in the data later in the year. This year's moves really were dominated by primarily tariffs, trade wars, and fiscal policies. Now moving on to my guests' outlooks. Thomas Hayes, managing member of Great Hill Capital, is a hedge fund manager and is a regular on my show. He's made a series of correct calls on the market direction as well as Fed monetary policy throughout last year and this year. Here's what he had to say about where the broad indices are headed from here on his latest appearance with me just a week ago.
I was shocked. While sentiment has started to recover, as of a week and a half ago, it's still similar or in the range of levels not seen since the COVID lows and the great financial crisis lows. I mean, you can't make this up. And the market was like a 1.5% off of all-time highs a week and a half ago, and managers are still underweight, non-believing, pessimistic. Most of them had been waiting for a retest of the lows, and now they are being forced buyers. Okay, so the shorts have had to cover. They were the first buyers. Now the institutional managers that sold in the hole are being forced in on every positive headline, whether it's a deal today with Vietnam or, Japanese not taking our rice, now taking our rice. I mean, you can't make this stuff up, or the Canadians dropping the digital services tax and coming back to the table. Every new headline is going to force more money into the market, and there's still a lot on the sidelines. Then you take global M2 money supply is now at a record. It had been basically flatlining since 2022. So you got liquidity in the market. People off sides on positioning have to chase up to keep their jobs to catch the indices. When you're behind the mark on performance and the indices are ahead of you, what do? You buy the catch-up trade. You buy the laggards, which is why I think the second half is going to be dominated by the the 493 versus the 7.
Or is this just the beginning of a new rally?
No, I think we'll push higher here into earnings season, probably the next few weeks. And then I think we got to consolidate some gains, maybe, August, September, October, grind sideways, maybe a little natural pullbacks, et cetera, and probably finish the year a little stronger. So again, if you're hoping that the indices are going to go up another 20% in the next 3 months, I'd be looking under the surface for real opportunities that can double before the end of the year, because the indices, if you're looking for another 20% in the next to finish out the year, I don't think you're going to get anything close to that. But I do think there are enough companies primed that you can find enough doubles that the indices aren't going to matter if you do your work.
Here's what he said earlier in May regarding market sentiment and short-term price action.
Usually what happens is everyone probably bought up on Thursday and Friday after 8-9 days up. And so those people need to get punished. So my guess is you'll see some short-term volatility in the coming weeks, maybe a few percent pullback just to hurt the Johnny-come-latelys. And then when the bears think they're back in control, we rip higher. And that would be consistent with what we saw in the 2018 recovery in Trump 1.0. So look, those are best guesses. I mean, at the end of the day, I just like to look at companies, and what I did on I did a call on April 7th for my clients, and we went through company by company, just the free cash flow and the balance sheet. And we're like, look, the worst case scenario can happen. These things are priced for that. And if you get any possible good news, we're going to have the most incredible few months we've ever seen. And that's been the case in the last few weeks. It's been insane to the upside. And fortunately, I have really incredibly smart clients who were sending in a ton of money at the lows to buy stocks versus the opposite. So very grateful on that front. And, we take it week by week. As the facts change, we adjust our viewpoint. But on balance, what we said in the beginning of the year, I think is going to hold true. I like the high single digits upside for the S&P 500, and maybe a little more if we get a lot of good news. But it'll be some bumps between now and then to get there, and just use those as opportunities.
Okay, now on Bitcoin, the world's largest cryptocurrency, it surged to a new all-time high of $118,403 on Friday, marking its third consecutive record close this week. Let's flip over to my chart on Bitcoin. Here's a Bitcoin chart. So as you can see here, it's gained roughly 26% year to date, marked by periods of ups and downs. It's roughly matched gold's performance as institutional money flooded into spot ETFs. Bitcoin's 2025 rally accelerated after breaking through May's resistance level of roughly $110,000. Now let's take a look at what happened after that. The current rally this week was partly driven by $1.8 billion of ETF inflows on Thursday. That's the second highest daily total on record. The price was oscillating up and down, but it's rebounded sharply from the early year volatility. Cumulative ETF inflows reached $51 billion this week in 2025 so far. Bitcoin's 2025 performance this year has been shaped by some of the same dramatic policy and geopolitical events that rocked traditional equities markets, but with even more pronounced volatility on the ups and downs. And following Trump's January 20th inauguration and his crypto-friendly executive orders, Bitcoin initially surged, as we can see here, alongside broader risk assets. It weathered the Liberation Day crash of April 2nd, so it went down only 11%, which is slightly less than what the stock markets did, to its trough before rebounding. So interestingly, like I pointed out, it didn't go down as much as stocks, which is why some commentators at the time speculated that Bitcoin was starting to behave more and more like a risk-off diversifier asset similar to gold, or as its nickname, digital gold, would suggest. However, Bitcoin's most dramatic moves came later on in the year during June, when political tensions arose. Operation Rising Lion on June 13th, that's roughly here, caused the price to sell off from about $110,000 near the start of June to roughly $101,000 at its trough in mid-June. The brief U.S.-Iran military exchange from June 23rd to 24th, interestingly, coincided with Bitcoin rising back towards $110,000. That's interesting. This move strengthened Bitcoin's narrative as a geopolitical hedge as well. So let's take a look at what some of my guests have said about Bitcoin. Matthew Sigel, for example, he's the head of digital assets research at VanEck, called this rally in Q2, and he maintains an even higher Bitcoin price target outlook for the end of the year. Take a listen to his year-end target.
People love your Bitcoin price prediction. Can you tell us your prediction, short-term, long-term, maybe 2025 and 2026?
Sure. Yeah, we've been really encouraged by the interest from the traditional asset management community into Bitcoin ETFs, especially since the election. My inbound phone calls are up like 300% from investment advisors who were afraid to allocate to Bitcoin ETFs, and now with the election and the change in administration, they're much more open to discussing the investment case for Bitcoin. So this is obviously a very volatile asset, and so we look at the short term. It tends to be driven by macro considerations, liquidity trends, and technicals. So assuming that Bitcoin can get through this period of uncertainty, which we think is macro driven, interest rates come down, the Fed gets a little easier, we think the second half of the year should be quite positive, and that Bitcoin could reach 180,000 per coin. That's based on an analysis of previous Bitcoin cycles, which have tended to get smaller over time. But the previous smallest Bitcoin cycle was a 20x return from the trough to the peak. If we can do a 10x return this cycle, that would imply 180K. So that's kind of our guidepost for this year. Again, liquidity and technicals could change that, but that's my base case is 180 for this year. For those advisors taking a longer-term perspective, we benchmark Bitcoin against gold, specifically the 50% of the gold market that is more speculative in nature. So about half of gold goes into jewelry or industrial use cases. Putting that aside, if Bitcoin can reach the 50% of gold that's speculative in nature, that would imply roughly 450,000 per coin. So I know a lot of folks are calling for that this year. That would mark a break in that cycle. Each cycle gets smaller for Bitcoin. So I have a hard time calling that for this cycle, but that could be maybe a 2027, 2028, 450 per coin. And then over the longer term, we think there's a good chance that central banks and sovereign wealth funds will start to get more aggressive in adopting Bitcoin, not only as a store of value, but also as a medium of exchange. So this year, the Czech Republic, the governor of the central bank there, has initiated a study to analyze Bitcoin for inclusion in their central bank reserves. And then just this week, Russia did a trade with China, partially denominated in Bitcoin, beginning to really use Bitcoin for the first time as a medium of exchange.
Still, some experts have some reluctance to being overweight U.S. equities. Here's Jan Vanek, CEO of VanEck, on market headwinds. Let's just start with the broad market outlook. Like I mentioned in the introduction, the S&P 500 posted its best May performance since 1990. Gained over 6% in just 1 month. You told CNBC in April that investors should shift away from U.S. equities due to geopolitical factors. Can you just elaborate on that and why you think people should be shifting away amidst one of the strongest bull rallies in recent history?
Yeah, I mean, listen, I think there's one big macro overhang, and we're almost like the calm in the middle of a hurricane, David. It feels good. Feels normal, feels quiet. I mean, even things like Bitcoin have low volatility right now. As you said, the market's retraced all its losses, so we're kind of flattish on the year. But we've got this big macro overhang, which is our budget deficit, and we just don't know how it's going to shake out. Now, let me put some context around that really quickly. The U.S. budget deficit, I'm not going to recite all the statistics. Everyone knows that our budget deficit as a percent of GDP is unsustainable. That's basically the fact. I mean, unless the government ends up buying all the debt that we need to issue, we can't continue at this pace. And the question is, will Washington cut that ratio significantly, Or will the market bond vigilantes come out, freak out, and drive the 10-year up to, something scary, 5, 6, 7, 8%? Because only that will then force Washington to stop spending money. We don't really, it's a little bit we don't know what's happening with the Senate negotiations. Everything is behind closed doors, as far as I know. So we just have to do a little bit of a wait and see. But the reason I was bearish on equities is only that I figured that we would have to cut spending to a certain extent. We just can't have what I've been calling 2 feet on the gas pedal. And so that would lead to lower economic growth and therefore a little less support for equities. So that's sort of that's the overhang. Timing is everything is super tough. So I'm not saying get out of the market. I'm just basically saying expect that there'll be less fiscal stimulus in the second half of this year. And the administration has basically said they are willing to absorb that. I mean, Trump even used the word recession several months ago. Besson has talked about deleveraging and normalization. So that's where I think we're at.
You talked about in Q2 2025, in the middle of a 3% reckoning in your April outlook. What do you mean by reckoning? What is this 3% pullback you're referring to?
Sure. So I've called 2025 the year of the reckoning for about a year now because Americans are on an unsustainable debt path, as I mentioned. People say, oh, we'll never default on our debt. Our Social Security system in 2033 will cut payments. So let's call it go bankrupt in 2033. And you can't fix a retirement system at the last minute because you're dealing with so many people and so many liabilities that need to be adjusted. So the United States has this habit of only addressing major issues the year after a presidential election. So here we are, there's 2 presidential elections before that Social Security default, 2029 and 2025, right? And so that's why I said this is kind of it. And we're not even talking about fixing Social Security. That effectively means that we are slow marching towards a default of Social Security. Again, payments will only be cut to 80 cents on the dollar, but when you don't pay back 100 cents on the dollar, last I checked, that's a default. So that's why I say we're in the middle of this reckoning this year. This is the time, especially with the sweep of both the House and the Senate by the Republicans, to fix this policy issue or not. And if we're not going to fix it, then there will be, I think the markets will call for a reckoning. So I know that's a little bit of a, we don't know the outcome situation. It's where we find ourselves in. The risks are clearly that Americans need some protection in their portfolios, which is why we talk about gold and Bitcoin, which are in multi-year rallies, hitting all-time highs both this year. And that's what people should be doing in their portfolios, protecting against this potential outcome.
Back to Bitcoin now. Here's Mike McGlone, senior commodity strategist of Bloomberg Intelligence, on comparing the performance of Bitcoin versus gold and stocks, and using gold and stocks as a barometer for Bitcoin's future performance. Take a listen. Gold and Bitcoin, actually, Jerome Powell just recently said gold and Bitcoin are competitors. We can touch on that.
Or in the Federal Reserve itself, in terms of the system. What do you think of that idea?
I don't think that's how people think about it. I mean, it's so, people use Bitcoin as a speculative asset, right? It's like gold. It's just like gold, only it's virtual. It's digital. People are not using it as a form of payment or as a store of value. It's highly volatile. It's not a competitor for the dollar. It's really a competitor for gold. That's really how I think of it.
But is Bitcoin, before we just touch on gold, is Bitcoin at the end of its bull cycle at 100K? I think that's what people want to know. Are we at the top?
Well, let's look for someone to blame. And picking tops is a good way to lose your hair. But I think and it's one thing I've learned in this business, certainly when you're on the sell side with a client and you get them in a decent trade and they ask you to take profits, you never say no. First of all, you got to get the trade, and you want to have money for the next trade. But also, it's essence, taking profits, the essence of business. To me, this is the most, I like to tilt it over to the whole space. You just look at Dogecoin. What is $60 billion in Dogecoin mean? The future is going to look back, and it did in, I think, 1929. It's just silly, expensive, speculative excesses. Now, that's one of the 2 million or so crypto wannabes. Then there's Bitcoin, digital gold. The thing is, I just think it's like I mentioned what's happening in the ETFs. I think it's pointed out it's reached somewhat parity on a risk adjusted basis with gold ETFs. And they've been around 20 years. And this is a pretty significant level. But also I keep to point out is it going to get better for Bitcoin than what happened this year? I mean, to me, this was the best it could have ever been. Yes, and maybe it continues to move up another 30-40%, but expecting the 2x next year, you have to firstly say, okay, well, the stock market's probably need to go up another 30%. And that might make sense. But what if the stock market's down 10%? Bitcoin will be down 30%, unless that relation shifts. And that's what I want to end with. On a 100-day basis, the Bitcoin to S&P 500 correlation is about 0.50. It's the highest in its history.
Let me just take a look at the screen here. If you take a look at my screen, Bitcoin versus the NASDAQ. So Bitcoin's up about 166% 138% year to date. That was 1 year. And then the NASDAQ's up 35%. Over the course of the year, after the ETFs were launched, we had this massive inflow, and then it just traded range bound, as we know, we've been on the show several times, just this downward consolidating pattern. And then it wasn't until near the election, right, beginning of November, end of October, that it really started to sniff out Trump's win, and then it just kept going up. I wonder how much of this is just news-driven expectations of policy changes and has nothing to do with the fundamentals of stocks or risk appetite.
All the former. It's completely momentum. And we all know how that works out. It's in shorting it, that, again, you can lose your hair. But prudent investors, I think, look at this and say, thank you, this is not a place and time and an asset to get overweight long. Now, okay, some of us got lucky in 2000 when I first pointed out, overweight long around 10,000 is great. But now that you're at 100,000, it's probably a prudent place to be booking profits and looking back and waiting for some normalization. That's why I look at it as we have not had a 10% correction in the S&P 500 since fourth quarter of 2023. I predict we will have one. Again, you want to blame McGlone for something? He's predicting it again. It's silly, but it's my job to predict things like that. But it's silly not to have that. It's just the point you get to a certain point we've priced in absolute perfection. Yes, I get it. Trump's a new, but now we price in complete optimism for this new government. And I think the realism is, yes, that's probably going to be the case in a couple of 3 or 4 years. But the first thing is going to be pretty substantial tariffs, pretty substantial shakeup in jobs and government jobs, which means maybe we'll finally get the first 10% correction. Remember, that's nothing. Normal used to be 20% corrections. That's just how price for perfection we are in risk assets. And that's why I put Bitcoin in the stock market in the same space. It's just Bitcoin's now more of the global leader and certainly on a 24/7 traded basis.
I'm thinking, Mike, almost everyone I've talked to in the last 2 weeks has said to book some profits at around the 100K mark. And I know it's psychological. And I know that's what people are doing right now because it hasn't broken above 100K and sustained about the level. Isn't the contrarian play, because the theme, I guess, this time around is contrarianism, isn't the contrarian play to do the exact opposite of that? Start buying, accumulating at maybe 99,000 and expect it to go higher. I'm just...
Or traders, sure. And exactly. I love when you play devil's advocate. That's why I love talking to you. That's what you're supposed to do. So I'm used to my whole life with clients. And you're supposed to. The thing is, you can do that. And I think I'm more of a leveraged trader basis. Yeah. But your average person that I didn't, back 4 or 5 years ago, I got the questions and it was kind of hard to buy it. And now I get it all the time and it's kind of scary. Everybody can just push a button and buy IBIT or even GBTC, whatever, buy ETFs. It's just at the point, sure, for a trader standpoint. And that's the thing we're at. It's silly stage, David. It can get really stupid expensive and markets oftentimes do. You got to stop out look what happened to Microsoft. MicroStrategy, I think is really stupid, silly expensive because we're squeezing some of them shorts. But market's supposed to do that. And remember what Soros says, find a bubble and join it. But I look at it from a macro standpoint and give it at least a year or something. I'm just looking forward to next year. Bitcoin is still not even, it's not past the test. And we've had plenty of tests. And if you haven't had a test, one this year, just give me a 10% correction in beta, S&P 500, and typically it drops a third. Now, that's something I'm looking for to help test my outright views. Maybe if it does that and Bitcoin drops less, I can reassess my view. But the fact you said that about profit taking, yeah, that makes sense. It's good we've got to this level. But there is, is it going to get better than what happened this year? Those 4 horsemen, the things that happened this year with Donald Trump switching is just, that's like I looked at it as it's like a bargain with the devil for Bitcoin people. And again, you get your Shiba Inu to $60 billion. Doesn't say it can't get to 100 billion. But these things always end up going back down much more than you expect when they do go down. It's a question of when.
Michael Lee, founder of Michael Lee Strategy, expressed shock at how quickly markets recovered from Liberation Day back in May 1. He's still very bullish despite having been bullish all year round, and he called this rally. Take a listen.
With Adam Sandler, and his mommy comes out and says, foosball is the devil. That's the way we talk about tariffs here, but they're literally used everywhere else in the world to promote domestic manufacturing, and they have not caused this Armageddon that many were predicting in markets. So I'll say throughout this chaos, I'm on the record many times saying we will recover these losses. I'm just shocked at how quickly we recovered it and how much the market has moved. And boom, yesterday we get a close above the 200-day moving average. So the conversation has gone from like, okay, is the world going to end, to when are we going to be okay, to, oh, wow, it's looking like we've got a lot of ground back, to now, boom, when's the new highs coming? When are we going to make brand new all-time new highs? And I think that needs to be very real. It can happen in the next few months because the long exposure in the hedge fund community is at 5-year lows. So the net long investing, why does that matter? Because now they need to go out and chase performance, right? And not only that, you have a lot of people that panicked and sold on the institutional level, on the retail level, that are going to want to get back in and get invested so as to not miss out on this in the future, especially with this China de-escalation. So it has been a crazy year, to put it mildly.
Lee projected 10 to 15% market gains over the next 3 months to all-time highs. Here's why.
Now we've surpassed that 200-day moving average. I don't know if we'll test that support, when we'll test that support, but there's almost somewhat of a floor in there now, and you have the entire hedge fund community completely offsides with where the market's running. You have inflation prints like we got today creating short squeezes. In the near term, like we could really run 10 to 15% over the next 2 or 3 months and set all-time new highs, right? And that has more to do, I think, with this hedge fund community being completely offsides and earnings coming in better. These tariffs haven't translated into any sort of inflation.
Rates are coming down. In a year from now, there's a chance rates could be 250 basis points lower than they are right now, or 225.
Let me ask you this. Hypothetically, what would the Fed funds rate need to be for the S&P to touch 7,000 points?
Oh, it doesn't have to move. Like, we're on our way there. Yeah, like I think a year from now, you're talking about S&P 7,500.
Here's James Seyffart, ETF analyst at Bloomberg Intelligence, explaining the catalysts for this year's Bitcoin and crypto bull run and what's next.
Well, catalyst for the next bull market. We talked about why it's been down. We talked about flows being weaker. We had catalysts last year. The launch of the Bitcoin ETFs, the launch of other ETFs, change of administration. What are we looking forward to next?
Yeah, if I have to look for something that is the most optimistic viewpoint, let's just stick with Bitcoin for now, because I think altcoins have their own headwinds and there's a lot of competition there, as I kind of mentioned. But if we're just looking at Bitcoin specifically, I look to exactly what we were talking about, those advisors, institutions, corporations getting on board with a Bitcoin standard in some way, or just putting a 1% to 2% allocation. For the most part, it's I've heard of stories more and more over the last couple weeks and couple months of advisor platforms allowing people to buy Bitcoin ETFs. A lot of people think these Bitcoin ETFs launch and it's okay, now every advisor can just buy them. That is not how it works. There's a whole due diligence process. Oftentimes it takes 3 years. From what many of them are accelerating them because they want to be able to get the Bitcoin on the platform. But even still, initially, for the most part, if say I'm your client, I'm your advisor and you're my client, I can't, in most places right now, I can't recommend a 1% to 2% allocation to Bitcoin in your portfolio. But if you come to me and say, I want Bitcoin in my portfolio, I can do it, right? Because it's unsolicited versus solicited. I can't solicit you to buy this thing. That process, and in some cases, even if you come into me and say you want to buy it, there are some places where you still can't buy the ETFs. They don't even allow it. So there's kind of these different levels of what you can do. And even still at the level where you can recommend it or you can allow people to buy it, there's a lot of restrictions. You need millions of dollars with them specifically. You need to have a high risk tolerance. So the vast majority, the trillions of assets at these wealth platforms, at these wirehouses, these brokerages, they still are not fully on board with buying these things. Now, granted, do I think all of them are going to put a 1% to 2% or 5% allocation to Bitcoin or crypto? No, probably not. But even a small portion of them doing it for a lot of their clients, it's going to create a lot of demand. So I think that's the next wave of demand potentially for Bitcoin. And if we're talking about other things, we're going to see index. We already have index ETFs at launch. Right now, they just hold Bitcoin and Ethereum. We're going to see by July or August, they're going to have index funds that are mostly Bitcoin and Ethereum, but also holding 5 to 8 other assets, right? So they're going to be, I think that will be another wave of demand, because if you're an advisor and you're looking to get exposure to the space, you're like, well, do I really just want Bitcoin, or do I want to get, an index exposure, what I'm used to doing for stocks and bonds and things like that? So I think that's another wave of demand. But overall, the regulatory environment, we've gone from a point where we were facing massive headwinds to now we have tailwinds, and the price, ironically, is going the opposite direction. So I think there's like a disconnect between what's looking at on the underlying fundamentals of this industry versus what's happening price-wise. And as we talked about at the start, I think it's largely just what's happening with risk assets, Trump talking about tariffs, all the different things that Trump is doing with the global order, if you will.
Do you think we're heading into a recession?
I'm definitely not qualified to answer that. Our economists think there is a chance of it at Bloomberg, but my view is I think things look like the underlying fundamentals of the economy are pretty strong. Inflation does seem to be coming down if you look at where things sit right now. Right now, the Fed is pricing for 2 rate cuts, so obviously rates markets aren't really pricing for a recession. I don't know. I think things are relatively strong. The big concern is, the federal deficit, and that's what Trump and Besson and Lutnick and you name it at the U.S. Treasury are focused on, the U.S. government are focused on. So no, I don't think we're heading for a recession. I don't think it's zero probability. I mean, we had 20+% returns in 2023 and 2024, and going into 2025, I was like, look, guys, that's not how things usually work. We're going to be due a pullback, and I think pullbacks are healthy in the TradFi markets and in the DeFi market. So, recession, I don't know. Not qualified to answer it, but I think if we do have a recession, it should be relatively mild, just because there's so much home equity built up in the U.S. specifically. Assets are up very high. I think a lot of people have very strong balance sheets. And you see all these charts of people looking at credit card debt and all these other things. And it kind of like what I was saying about the Bitcoin ETFs, people talk billions of outflows. It's like, well, put a denominator on the amount of debt that we're seeing in the U.S. and you look at like assets and balance sheets of the average American, and it's like very, very strong. There are some upticks in delinquencies and mortgage rates and things like that. It indicate a softening economy, but it's hard to kind of stop the economy from softening once it goes in one direction. But does that mean we're going to go into another 2008? Probably not. That's my basic take.
Here's Ed Yardeni, president of Yardeni Research, from the summer of 2024, making a bold call on the S&P 500's performance in 2025.
I'll start focusing on next year's forecast, which is 6,000 on the S&P 500 and 6,500 for 2026. Then by the end of the decade, I think we're going to see something around 8,000. So these are all sort of my base case, 60% most likely roaring 2020 scenario. And then on top of that, I've got a 20% case scenario in which this turns out to be a melt-up very similar to the 1990s. And I'd tell you, the past week or so, it's felt increasingly like it might be that 1990s scenario.
Last fall, I interviewed Ed, and he doubled down on his bullish call. You were calling for the roaring 20s to start. People literally laughed at you in the comments. We got 6,000 S&P not too long ago. It doesn't look too crazy now. It's only about a 33%, 34% increase.
Correct.
Current levels to 8,000. Are you sticking with that thesis?
No, I'm actually more bullish, because I think under Trump 2.0, we're seeing we're revisiting animal spirits. Remember, that was what happened in Trump 1.0 when he got elected. The stock market took off on the same reasons that it's taking off now, and that is the tax rate for corporations is going to be cut from 21% to 15%. There's going to be a lot of deregulation, and that's what the stock market's embracing right now. This is not going to be straight up from here, because on the other hand, we've got tariffs, which could be inflationary, could actually be deflationary if it's too much in that regard. And of course, there's an unknown here about the deficit, though I think Trump has bought us some time by bringing in Vivek and Elon to run DOGE, the Department of Government Efficiency. If they're successful in cutting back some spending and at least taming the growth rate of spending, that could be a big deal.
Tax cuts back in 2017, how effective were they in propping up the stock markets? I know it took some time for the bills to pass, but generally tax cuts, how bullish would that make the markets?
Well, a tax cut goes straight into earnings because what it does is it increases the profit margin. So back, I think it was finally got around to cutting the tax rate in 2018, the profit margin had a nice big move to the upside, reflecting better earnings. So it discounted it pretty quickly. I think we've actually discounted some of that already in the market. Maybe we'll give some of it back after the initial knee-jerk reaction that this is going to be mostly bullish, because I think there clearly are going to be some concerns along the way here. But basically, it's a big positive for earnings, and I think in this case it could increase the profit margin by at least half a point, if not 3/4 of a point. The last one increased the profit margin by a full point. And then there's the unknown of the known unknown about how much will deregulation cut costs, and then how much will deregulation unleash animal spirits. Animal spirits is what John Maynard Keynes described as spontaneous optimism. And we certainly had that in the days following the announcement that Trump had a clean sweep following the November 5th election.
Ben Cowen, founder of Into the Cryptoverse, explained the importance of seasonality in Bitcoin performance and Bitcoin dominance.
But my mom's retired friend said, Bonnie, you said Bitcoin is only going up. Why can't I buy it with my retirement money?
Well, over a long period of time, it's probably true. But even with Bitcoin, if you think about all prior cycles we've had, in 2022, it dropped, 77%. In 2018, it dropped 84%. In 2014, it dropped 87%. And in 2011, sometime around 2011, it dropped like 90%. If you have the patience to watch it play out over a very long period of time, more than likely will go up over a long period of time. But what a lot of times happens is it's hard to convince people when the market is not very exciting, and then they only want to join when the parabolic phase of the cycle is occurring.
Where are we?
So normally post-halving years are cycle tops, normally. 2021 was, 2017 was, 2013 was. So unfortunately, all prior post-halving years have been cycle tops. The good news is, the bad news is we have diminishing returns. So we should expect a lower return as measured from low to high, high to high, and low to low. But the good thing about diminishing returns in this case is it also has historically come with diminishing losses. So even in the bear markets, every subsequent bear market, Bitcoin has dropped less and less and less. So, I think it's one of those things where if you're going to hold it, you have to be aware you're going to have drops occasionally. And it usually happens after, euphoria phases and a lot of times when it happens is when the other assets in the cryptoverse start to do very, very well. Because when the froth rises, that's when the market normally needs a correction. Even if you look at it in a shorter time frame, in early 2025, Bitcoin found a local top around January 20th, the same day the new administration took office. And the reason is because, you're pricing in perfection. You're pricing in a strategic Bitcoin reserve, right? You're pricing in deregulation and all this stuff. And then when things can't get any better in the short term, you normally get a correction, right? And so I think there was some elements of euphoria back then. We cooled off going into April. Now we're getting a bounce into the spring, and it makes sense because they had all the tariff tantrum to some degree, and I'm hoping we'll see the current strength last a little bit longer. I do think we will see a pullback sometime in the third quarter. Third quarter historically is pretty weak for Bitcoin. August and September on average are the worst months for Bitcoin. I'm pretty sure Q3 in 2022, 2023, and 2024 were all slightly red for Bitcoin. So probably makes sense to be aware that there likely will be a pullback in the third quarter of the year.
Back to stocks now. Chris Vermeulen, chief market strategist at the Technical Traders, said in late June that markets are coming to life with the Toronto Stock Exchange hitting all-time highs and the NASDAQ also flirting with highs back at the time. He explained that once the S&P 500 breaks its February high, which I guess is now, and sustains for a day or a week, a new bullish trend could be established. Take a listen. We'll follow up with Chris soon.
With markets kind of coming to life this week, and today people are in pause. I think there's a lot going on. People are debating like what is going on with the stock market, what is going on with the global kind of war situation. We got the Toronto Stock Exchange hitting new all-time highs yesterday. The NASDAQ is flirting with all-time highs today. People don't know what to do. Either people have been betting against the falling market and they're deep underwater. The trades are going against them and we're hitting new all-time highs, which has people kind of frozen. When people get nervous, they freeze. They usually they just don't do anything. And then people who aren't long the markets, they feel like they're getting left behind and they don't know what to do. Is this a real breakout or is this a fake out? And with the news with the ceasefire yesterday, people are kind of wondering, okay, is this just like a headline news and nothing's really changed? I think we've really learned in the last 6 months or so that a piece of news comes out and there's a new rule set, and then by the nighttime, the rule's been delayed or moved. And so now everybody's really questioning all of these big news pieces. Are they real? Are they going to change? So I think people are just nervous at this turning point. It's like most people are either on the wrong side of the trade or not involved in this rally, and people are frustrated. And now we have this ceasefire and new all-time highs, and they don't know what to do. And that's why I think we have a bit of a lull in this market, as you said, David.
Okay, can we just pull up a chart of the S&P 500? So it has hit its previous high in February. So the previous high in February was around 6150 for the S&P. What happens once we breach that level and sustain that level, Chris? What does that mean?
Yeah, well, once we break that level, from a technical standpoint, people who are short the market, meaning they're betting on falling pricing, they're going to naturally want to and somewhat have to cover, because now the market will be hitting new all-time highs. So what the market is good at doing is always trying to make a nominal new high or a nominal new low to try to run the stops, to try to push people's emotional triggers to make them eject out of trades. And so if the stock market makes a new all-time high, there isn't any overhead resistance. That's the problem with holding an inverse play or betting on falling pricing when the market hits a new highs. There is no resistance. So if we hit that level and say it can hold for a day, ideally it would hold for a week into a new high territory. People who are short the markets are going to want to cover. Also, they're probably going to want to get long the markets because now we're at all-time highs and the trend is up, and you generally want to be trading with the trend.
Later, Vermeulen suggested that the current S&P 500 rally may be converting from a dead cat bounce to either a double top or nominal new high. We shall see.
So on one side, we have the NASDAQ hitting new all-time highs. The other side, the S&P 500 hasn't quite. And we're in this turning point. We're in a strong uptrend right now. We've had this what I called a dead cat bounce, which you and I talked about, I think pretty much on the day the bottom was put in place. Expect a very strong bounce. And this bounce is dragged out, and now we're testing all-time highs. And now it's kind of converting from potentially a dead cat bounce to a double top or maybe a nominal new high. But we got to be very aware this could very much so be a shakeout. This is what the market does. It'll get the shorts to cover. It'll get people who aren't long finally to get long, and it could create a pop. I show the NASDAQ and the S&P 500 could rally 5 to 8% over the next couple of weeks and then have a sharp reversal. That would be kind of like an unwinding of people who are on the wrong side of the market and also people who aren't involved yet to pile in and kind of push the markets higher. So this is something you and I actually talked about many, many months ago. I said maybe the market comes up and makes a nominal new high. It sucks traders in, it gets the shorts out, and we're starting to get to that scenario.
Finally, Arthur Hayes, famous for being the inventor of perpetual futures contracts and the co-founder of BitMEX, currently he's the CIO of Maelstrom, has a $1 million Bitcoin price target to be driven by $9 trillion of money printing, he said. Here's how the timeline works, and here's how that would happen. Just, you talked about this a lot in the press, but just give us a sense of the timeline of Bitcoin to $1 million by 2028. You said 250 by end of the year. Is that still your timeline, or have you changed things
so I
since?
think that we get to 250,000 by the end of the year. It'll be bumpy along the way, obviously, but that's sort of my end of year price target. And then $1 million Bitcoin is what I just got off stage talking about how they're going to print, I think, in the realm of $9 trillion-ish between now and that period of time. And that is, Fannie and Freddie, the government support entities that are allowed to create mortgages in the US, they will print $5 trillion. You will have probably up to $1 trillion purchased by the banking system due to supplemental leverage ratio exemptions and purchasing things that the foreigners are selling. And I think the banks are going to because they now don't have to hold all this equity capital against their treasury book. They can lend more into the real American economy. And so you're going to see the amount of loans going to manufacturing firms increase, which is, again, that's an increase in credit, and that will make its way into crypto as well.
When the Fed printed a limited QE back in 2020, all asset classes went up. It wasn't just Bitcoin. So this is good news for Bitcoin, what you just said, the thesis you laid out, but it could be good news for everything else, including stocks, gold, potentially even bonds as well. Why would Bitcoin in particular outperform everything else in a
So Bitcoin has a fixed supply. It's obviously a much smaller market in terms of market cap. And so if you have a lot of things chasing a very small door, then the price goes up on the margin. And so that's why Bitcoin has been the best performing financial asset in the last 15 years.
Well, actually, on that note, in early April, you saw bonds go down with stocks, Bitcoin, yield went down as well, yield went up. So I wonder if capital controls are going to recreate that kind of scenario where all asset classes go down slightly, and basically we'll have less liquidity in the U.S. system.
I think that it'll be rolled in slowly over time. And so you're not going to see this knee-jerk reaction. I think the Trump administration learned that these sorts of massive sort of changes are going to create outcomes that they don't like, which is heightened bond market volatility, things going the wrong way. And so if capital controls are going to be phased in over time, they know that they need to replace that buying. Either it's the Fed, it's the Treasury, it's the banking system, it's some other private sector actor that is allowed to create credit very cheaply and therefore replace these foreigners who will be forced to sell these assets.
Stocks have re-correlated with the 10-year yield, and so has Bitcoin. Do you see that correlation holding between these three classes?
No, I think that there will be some risk off events, and we'll see bond market volatility heighten. I think Bitcoin will sort of assert itself as a hedge against this.
You once said, buy everything, Chai America lives. And then you talk about their breakup. Are they getting married or are they breaking up?
I think they're going to break up over time, but it's not going to be as quick as some people think.
Which is?
Could be decades.
Oh, I see. Okay, so tell me more about what happens if foreign money leaves, like to the global system. What does that look like?
Well, foreign money went into the U.S. because the U.S. markets have been the best performing, whether it's stocks, bonds, or real estate. And if that money is leaving and it's going to go back into their local markets, then the U.S. markets don't do so well. And maybe it's better to own Taiwanese stocks or Indonesian stocks or Thai stocks, or all these other emerging market countries who are basically going to say, okay, we're forced to repatriate this money back onshore. Our currencies appreciate. Our consumer gets wealthier because now they can purchase more things, and maybe people want to build business domestically to service that economy.
That's all for today. I hope you enjoyed this recap. Again, comment down below what you are doing if you're an investor or trader right now with markets at all-time highs. I'm interested to hear what my audience is doing with their money. As always, thank you for watching. Don't forget to like and subscribe. We'll see you next time.